Hey, this is Justin with daytradethemarkets.com, and in this video I want to talk about the what I call the 10-point scoring system. And this is a methodical way that I'll teach you to determine which setups are better than others so that you can basically avoid less favorable situations and then really go after more favorable situations. The idea is that if we get a score on this 10-point scale that's an 8, 9, or a 10, or even a 7, it's a pretty strong opportunity. And if we get something that's a 5 or a 6, it's a little bit more marginal. A 1, 2, 3, or 4 is probably the type of a trade we want to avoid. Now, of course, a 2 could win on any, could be a successful trade on any given trade, but if you take twos the rest of your life, you're going to run out of money, okay? And just the same way that, an 8 might not work on a particular trade, but if you take 8s and aboves the rest of your life, you're going to do very well. It's that idea. And the concept here is that the beauty of this is that it's really more than some holy grail system or something like that. It's more about learning to frame every trading decision through the very, very important lens of opportunity versus risk. So in other words, you're learning to judge with a few different factors that we'll talk about how good any particular opportunity is. And then number two, you're able to determine the true risk. In other words, how much risk would I really need to take before I know I'm wrong? And if the opportunity is good enough to justify that amount of risk, then it's a good trade and it's going to show up as a pretty high score. So, for example, a 10 would be a score that is a very, very high opportunity with very, very low risk. Okay, whereas an 8 or a 9 is either something with very low risk that's a good opportunity, or it's a very good opportunity with a little bit more risk. Okay, but again, it's all about judging the risk relative to the opportunity, and this 1 to 10 framework that I'll talk a little bit more about really helps you do that. So in terms of what components make up the 10-point system, there are a few parts. The 3 of the 10 points are made up of the big picture bias. 4 of the 10 points are what I call the now or today's bias. Okay, and what you'll see here is that this is our way of judging the opportunity, but we want to, the big picture matters and it matters a lot, but we want to weigh just ever so slightly more the now or what's going on today that's more recent than what's gone on over the past few days or few weeks. So we want to give a little bit more weight to what's going on today, but we want to balance both of them. And the other part is we're judging the risk on a given trade, and the lower the risk, in this case the higher the score, and the higher the risk, the lower the score. In other words, if you have a very low risk, it's going to add to our score, so we're going to get closer to 10 in that situation. And again, when we talk about what I talked about at the beginning, it's always about opportunity versus risk. This side is the opportunity side, 7 of the 10 points. This is the risk side, and the idea is that, again, consistent, successful trading, kind of the natural law of trading that you may have seen a prior video. It's all about being able to and having the ability to judge the true amount of opportunity in the market, and then to be able to judge the true amount of risk you'd have to take to go after that opportunity and determine if that risk is worthy of that opportunity. And if you always stay on the right side of the ledger on that idea and keep the odds in your favor, you're going to do very well. So I'm not going to get into too much depth here. I could go on for hours and hours about this, and certainly we do in our live sessions and in the course material. Take this, every step of the way and give a ton of examples. But for now, let me just give a few examples. But let's start with the idea of the big picture bias, again making up 3 of the 10 points. And the idea is that the big picture bias, we're judging the relative strength or the relative weakness of the market over the past few days and weeks. And we always want to think about the scores that we do in terms of what's the score if we were thinking about getting long, what's the score if we were thinking about getting short. So if our big picture bias on a given day was up and we're thinking about getting long, it's going to give us 3 points for a long score, or for the big picture score. If our big picture bias is up and we're thinking about selling, then we're going to get 0 points toward the 10 points on that particular short trade. Okay, so the idea here is that, again, same thing. If the market is down and we're thinking about a long, we get 0 points. If the big picture bias is down and we're thinking about a short trade, we're going to get 3 points. So again, obviously the big picture bias plays a factor in that. Kind of as an example here, if you look at this, let's say we're thinking about a long trade and our big picture bias is up. Well, we would get 3 points for a long trade with the big picture bias being up? What if the big picture bias was neutral and we're thinking about a long? Well, that's 1.5 points for the big picture score on either one. And if the big picture bias was down with caution, for example, and we're thinking about a long, we get 1 point toward our big picture score. Again, I don't want to get too in the weeds here, but that just trying to give you a feel for what that is and how that comes into play. Now, the next part is the now portion of the score, or today's portion of the score. And what we're looking at for the now, and this is more of an art form. This takes a little bit of time. It's not that hard. It just takes a little bit of time to learn because it's a true skill to understand this. And I talk about the ways that I calculate the now score, the different factors, and how I weight different things. And what you'll learn all of that in the course and in the live material. But the idea here is that if we're trying to judge on the day whether the day exists. We want to put kind of blinders on. We're just looking at today. We don't care what happened yesterday. That goes into the big picture score. We're looking at just today. That might be 10 minutes into the day. We only have 10 minutes worth of data to look at. It might be 6 hours in. We have 6 hours worth of data to look in. Whatever the case may be, what's going on today? Are buyers in total control? Are sellers in total control? Is neither side in control? Are buyers more in control but sellers are in play? Are sellers more in control but buyers are in play? We're trying to kind of judge it along those lines. And again, it's the same idea. We're always trying to think about this from the perspective of what if we're thinking about getting long or what if we're thinking about getting short. So for example, if we're thinking about getting long and we judge that the buyers are in total control, we're going to get 4 points for our long trade in the now portion of the score. Okay. Now, if we're thinking about a short trade and buyers are in total control, then we're only we're going to get 0 points toward our short trade. We're not likely going to do that in terms of the now portion of the score. Or if we say that sellers are more in control than buyers, but buyers are at least in play, and we're looking at a long, okay, then we're going to get 1 point in our now portion of the score. And if we say that sellers are in more control than buyers on the day, but not in total control, and the buyers are at least in play, but sellers are a little bit more dominant today, and we're thinking of a short trade, well, then we're going to get 3 points. Again, I'm going through this quickly. Please, if it's at all confusing, believe me, you'll get this. It'd be like riding a bike. I'm just trying to give kind of the overview. We're always thinking about it in terms of, are we thinking about a long? Are we thinking about a short? How many points do we want to give for the big picture? How many points do we want to give for the now portion of the score? And kind of, that's kind of our starting point. Now, again, the other part in the other 3 points is the idea of risk. Basically, and a lot of traders get this wrong, honestly. They either take the same amount of risk just because it's based on a dollar amount for every trade, or sometimes they take way more risk than they need. Sometimes they don't take enough risk and get stopped out before they're actually wrong. The idea here is we want to be able, and this is a skill that you'll learn, we want to be able to judge when we're truly wrong on a trade so that we know how much dollar risk we would have to take on this trade, and we can determine if the opportunity is worth that. So the idea here being that the higher the risk, the lower the score, and the lower the risk, the higher the score, going toward our 10 points. That's the risk portion of the score. So I think an easy way to do this is, let me just give you a few really simple examples here. Let's make the assumption for this, and I'm just going to use the most basic trade that we offer, the retracement trade. And again, if you've seen the video on trade setups, you'll know what this means. But just a very simple example. Let's make 2 assumptions. Let's make the assumption that the big picture is up, and let's make the assumption that for the now, the buyers are in total control. Okay, so what are we going to do if we're thinking about a long retracement trade and the big picture bias is up? Well, if we're thinking about buying, big picture's up, that's 3 points. Therefore, big picture's worth 3 points on toward this trade. Now, again, we're thinking about a long trade. Buyers are in total control. That's 4 points toward a long trade. So our now score is 4. We're up there to 7. Now, what's our risk? If our stop is going to be a few ticks below the low of the buying box, it's right there, and our entry is way down here, then relatively speaking, we don't have much dollar risk. We don't have much risk, dollar risk that we have to put at stake. So therefore, our risk is a 3, as opposed to if we were getting, long somewhere in here, it'd be more like a 2. Okay, so the idea here is that this is a 10. I mean, this is a perfect scenario where, in this hypothetical, our big picture's totally bullish, our now or today's bias is totally bullish, and our risk is very small. That's going to be a 10. Let's give another example here where if you have a situation where, same situation where the big picture bias is up, so we get, 3 points toward a long, and our now is that the buyers are in total control, so we get 4 points for the now score. This is a situation, again, 3 for the big picture, 4 for the now. This is a situation where we could justify the situation, the context is so good, we could justify taking a little bit of extra risk on this trade because the score is so high. So we still, if we put a risk of 2, we still get up to a 9, okay? And again, it's the risk in this case would be that if we waited for it to come all the way down to the low of the box, perhaps this market is so strong it's going to take off without us. Therefore, we can still get to a 9 score by taking a little bit more risk because the situation, the context of the market is so strong in this particular case. Okay, now here would be an example. Again, let's go with the same assumption, if you will, where the big picture bias is up and the now is that the buyers are in total control. This time, however, we're thinking about a short trade, okay? So if the big picture bias is up and we're thinking about a short, what do we get? Well, we get 0 points. And if the now or the today's bias, the buyers are in total control, but we're thinking about a short trade, we get 0 points. So again, big picture is 0, now is a 0. Even if we take extremely small risk here, we get, 3 for the risk. We only add up to 3 points. Do we want to take a trade that's 3 out of 10? Probably not. Now, of course, a 3 could win, but again, if you take threes consistently, you're absolutely going to lose money. So I wouldn't recommend taking that trade. And that's again showing that the idea being that we want to be able to frame the context of the market so that we know if the amount of risk we're going to take is worthy of the opportunity. So even if it's a small risk, it's just plain not worth getting short in a situation where the buyers are in total control. Let's look for a way to get long instead. So hopefully that made sense. Again, I know I'm going through it kind of quick, but just trying to give you a taste of this is the goal for this video. But let's go through another scenario. Instead of the big picture being up, let's say that the big picture is down. And in this case, however, today the buyers are in total control. So let's say that the buyers are in total control today, but the sellers are in total control over the big picture. Okay, that's what we would call a conflict day. And so what do? Well, again, we want to weigh the now a little bit more, give it a little bit more power. But even if we do that, again, if we're thinking about a long trade and the big picture's down, it means we get 0 points for the big picture. Okay, if we're thinking about a long and the buyers are in total control today, well, that's worth 4 points. That's a good thing. So now our now is at 4. Well, 0 plus 4 is just 4. How are we going to get to a 7 or above? We have to take very small risks. So we have to mitigate. We can take a nibble if we want, but we better mitigate the conflict on the day with our risk. We better keep our risk very, very tight and get to a 3 on the risk score, so that we can add up to a 7. It's still a bit of a marginal trade, but what you've done is you've taken a situation and you've said, well, I don't have the exact scenario I'm looking for. Do I still want to take a trade? Okay, yes, I do. Well, how can I justify that? Well, I better cut my risk down. I better be as conservative as possible on my entry, and I better be pretty nimble in terms of my trade management as well. So hopefully that makes sense. Let me give you just another example as well. Same thing, more of a mixed market here, and then we'll get on. But let's say our big picture is neutral. We don't really have a bias on the big picture. And let's say that same thing on the day. It's a choppy day. There's just not a lot of dominance from one side to the other. So let's say our now is that neither side is in control. Okay, and we're going to say that we're looking for a long trade again. So if we're looking for a long trade and the big picture bias is neutral, we get 1.5 points on a long for the big picture. And if we're thinking about a long trade and neither side's in control on the day, that's worth 2 points right in the middle of our scale. So right there is 2 points. So what do we have? 1.5 plus 2 is 3.5. What's the best we can do on risk is 3 points, which would give us a small risk. That's only going to add up to a 6.5. So 6.5, you can take it. It's better than a coin flip. Not the greatest trade in the world, but again, what you're doing is you're identifying. You have the ability to identify that this is a mixed market. I had better be careful. If I'm going to take a trade, that's okay, but the only way I can really justify that is with a very small risk, and I better be nimble. I better not really expect this thing to go to the moon. I probably want to expect this thing to go to the top of the box at the most and lock in my profit. Okay, so because again, the score is only a 6.5. That's a pretty marginal trade. It's something that you may even consider not taking. Okay. Um, I realize again that I went through this very quickly. Please don't, if you're confused, hopefully it made a bit of sense. If you're confused, don't let that affect you. And hopefully it did make sense. The idea is that you're going to learn this skill, and once you learn it, again, it's just going to frame the market and make it so much more, so much easier to determine when it makes sense to take a trade and when it makes sense to really pass. And this was just a tip of the iceberg. There are many other combinations, many other possibilities, a lot of different nuances that we can get into as you do this longer and longer, and we go through these examples in live trading as well. But the key point that I want you to remember is that it's not that this is some holy grail again. It's that this is a methodology which is it's helping you determine less favorable situations versus more favorable situations. And more importantly than that, it's helping you frame every decision through this lens. This is the true skill of trading. How good is the opportunity? That's our now score and our big picture score. And then how much risk would I need to take advantage of this opportunity? Does it make sense to do that? And if it does, we're going to get a pretty high score. If it's a little bit more marginal, it'll be in here. And if it's something we probably ought to avoid, it'll be down in that area. So again, I hope that made sense. If you have any questions on that, certainly just shoot an email or let us know any questions you might have. Certainly. Hopefully that made sense, and would love to work with you. And we will talk soon. Thanks so much for your time.